Hi, my name is Ola, and in this session, we'll be talking about bonds. Everything you need to know about bonds. Why you should invest in a bond, how to invest in a bond, the risk involved in investing in a bond, and how you make money from bonds in general. So if this is something that you have wondered about, then listen in. And of course, subscribe. Haha. Hi, my name is Ola, and I started off my career as a securities trader, specifically a fixed income securities trader. What is that? I started off trading bonds, treasury bills, markets, all that shenanigans, right? That's where I started from. So today I'll be sharing a little bit about what I know about bonds as an asset class, i.e. as something you can invest in. So this is going to be very relatable. So listen in, share with a friend, subscribe, hit the notification bell. We're here to explain personal finance, investing, and the economy in simple English so you can make informed decisions. Yes. So now, what is a bond? Before I go into what a bond is, it's important to know that this asset class is available wherever you are in the world. Like if you are in the United States, if you are in Nigeria, if you are in Canada, if you're in the UK, there are bonds that you can buy. So just know that it's for everybody. Share with a friend regardless of where they are. Now, what is a bond? A bond is a situation, let me put it like that, or a contract between two parties where you lend to that party. If you are the investor, you lend your money to that party for a long-term period. So it's basically that you are lending to a counterparty for a long-term period. The thing that makes a bond is the fact that it is long. It is at least 5 years, 7 years, 30 years, right? 50 years. That's what makes it a bond. It is a debt instrument. That is what it is called. That is the technical term. It's a debt instrument, a long-term debt instrument. Basically, you are lending, and you are lending to an entity for a long-term period. That is what a bond is fundamentally. What are the other things that make a bond a bond? Is little things like the terms around it. What are the features of a bond? Every bond that you see has something called a coupon rate. What is a coupon rate? A coupon rate is the interest that you are going to get. It's as simple as that. So let me tell you the backstory of why it's called a coupon. In previous times where people would actually have a certificate for the bond, now it's all dematerialized. If you have a bond, it's on one platform, you open your app, you see that you have a bond. But when it was paper, what happens is that the borrower would give you a certificate, and on the side of those certificates will be coupons, the way you know coupons, like you see coupons in magazines and stuff, right? There'll be coupons. So if, for example, you have a 10-year bond, there will be 20 coupons to pay you interest, because they pay interest twice a year generally with bonds. Generally, bonds pay interest twice a year. So if you had a bond that was paying interest 2 times a year and it was a 10-year bond, you would have 20 coupons. And what you were expected to do was, when that coupon was due, you would tear it out of the rest of the certificates and the pack and take it to the lender and give that to the lender and get your cash. That is why you call the interest on bonds, only on bonds, not on fixed income, not on treasury bills, only on bonds. That's why you call it the coupon rate. Tell me in the comment section if you've learned something new today. So yes, that's so the interest, what you get when you know, of course, when you lend to someone, except if you are doing family business, right? Family relationship type thing. When you lend to someone, you get interest back from the person. So the interest on bonds is called coupon. That's the first way that you make money. And that is one of the features of a bond. The other feature in a bond is the tenor. I just gave an example with a 10-year bond, right? Every bond has a maturity date. If the maturity date is in 10 years time and you are, for example, in 2027, right, it means that the bond will be maturing in 2037 and the tenor will be 10 years, right? Why is that important? Because if you are lending money to someone, you want to know when your money is going to come back to you, right? So those are the things that you look out for in terms of the features of the bond. Now, another thing also is the payment back. The payback terms, right? Your principal at the end, one time, bam. That is called a bullet repayment. But sometimes, after a while, they start paying back your principal slowly and surely, like a reducing balance or be a schedule. So those are the things that you need to know. Why am I highlighting the features? Because before you go into a bond contract, you need to know what to expect. So I've told you the interest rate, that's what you'll be expecting in terms of your cash flow. When your money is coming back to you, that's the maturity date. How long it will take for your money to come back to you, that's the tenor. And that's your money coming back to you. Is it going to be one time at the end of the 10 years, boom, that's bullet? And if you're going to start reducing that balance over a period, then it's a reducing balance. So those are the features, the general features of a bond. Yeah. Now you might ask, why should I invest in a bond? Why am I lending to someone for 30 years? Why am I lending to someone for 20 years? Why? Right? Why really do people do things like that? Isn't that wild? How do I know what's going to happen in the future? But let me tell you something. If you are investing and you're thinking long, then the bond should be in your portfolio. And the reason is very simple. A bond gives you steady cash flow. Remember that coupon story I told you? What happens is that every 6 months, cash is going to come in. Now, if you've ever watched any video on compounding, we can pop up one on how compounding is going to help you. And it's going to pop up somewhere here. Like in those videos, we explain why that cash that is coming in is actually gold, right? Once that cash comes in, the ability to reinvest it is major. It's a major part of you blowing in the future. So that cash flow that comes from bonds, that's secured cash flow. When I mean by secured, I mean once you enter into a bond contract and they're going to be paying you 10 million every 6 months, as long as that person you give that money to is credit worthy, go and sleep, because 10 million is going to hit your account every 6 months for the next 10 years. You can plan with that cash. That is what a bond does for you. You can literally say that I want to tie this bond to my, I want to tie this bond to my children's school fees or my living expenses, or I want to reinvest it. You can plan with it. That is one fundamental reason why you should have a bond in your portfolio. How is it different from a stock? A stock is such that the stock price may go up or down, number one. So your principal is not guaranteed. Number two, it is at the instance, or you are dependent on the management of the company to decide whether they pay dividend or not. Right? If the year is bad, if there's some regulation that has come up that makes them unable to, you can't insist that I want to get my dividend, even if the company is profitable, right? But with a bond, you can plan with this amount of money is coming into my account. Clearly, no shaking, right? That's what a bond does for you. Now, another thing that a bond does for you is, So in this, I've talked about capital preservation and planning, the ability to plan, right? And then a bond is actually lower risk generally, right? When I say generally, because you know when your money is coming back to you, you know how much you're going to be getting over a period so you're planning. There's no situation in which you know when your cash is coming back to you, right? And then you know that at maturity, the contract states that your principal is coming back to you and this is the exact amount. What it has done for you is that it has lowered your risk. So in a portfolio, if you decide to do equities, it's good and it's fine. But you know that equity prices, for example, go up or down. Venture capital, you might not see the movement in valuation, but you will not have access to cash or access to the assets until one random day in the future, right? But with a bond, you have lowered the risk of your portfolio. So that's another reason why you should have a bond in your portfolio. Yeah. Now I've talked about why you should have a bond in your portfolio, but I also need to highlight the risks of having a bond in your portfolio, because there's always that balance. Return is always a reward for risk. So you have to understand when you're investing in a bond, what risks are you taking? The first risk that you're taking is interest rate risk. What does that mean? You enter into a bond at 10% and you lock in your money for 30 years at 10%. But 2 months down the line, 1 year down the line, interest rates go to 20%, but you've locked your money in for 30. So in that situation, an interest rate risk has crystallized. Why? Because you could have been earning, let's say that 10% will be giving you 10 million a year, right? What it means is that you would have been earning 20 million a year, but because you've already locked in, you are exposed to that interest rate risk, and there's seemingly nothing you can do to fix it, right? And I'll keep you very busy because there are things that you can do, but it's quite technical. Yeah, but generally, once you're locking on a bond, you are exposed to interest rate risk, i.e. the risk that the interest rates go higher and you're unable to tap into that because you've tied your money in. Another risk that you're exposed to is inflation risk. Basically, in that scenario of, let's say the bond is going to be giving you 10 million 6 times So let's say the bond. So using that scenario about getting 10 million naira twice a year from a bond investment and tying it to school fees. So imagine that school fees goes from 1 million, 2 million that it was to 30 million. You realize that even though you did that, right, and it was good, but you still can't afford the school fees anymore. Right? You tried your best, but it did not work out. But I did a video breaking this down, and investments I will still do despite high inflation. It will pop up somewhere here. So please look at it and have like a fuller picture of how to balance things out. But long and short, inflation risk is a thing when you're investing in bonds, because there's a chance that this cash that you are piling up or you're receiving for as interest may not cover what you planned for it to, if you understand what I mean. So that's inflation risk. And the final risk I want to highlight when it comes to investing in bonds is default risk, credit risk. Basically, you know that you are lending to someone and you're lending to someone for a long period. So what happens if the company folds up? It's a real risk, such that when you are going into such transactions, you need to be looking at who you are investing in, which entity, what's this entity's track record, all those things, right? I also have a video, so there's a lot to learn. It's also important to highlight that when you're talking about investing, there's no number 1, 2, 3, 4, 5, and then that's it and you're good. There's a lot that you have to build up on. I have a video on questions to ask when I am investing in debt instruments, and a bond is a debt instrument. It will pop up here also. We'll also put in the description, why am I doing this? I'm bringing all those things together to a point where you know that, okay, this is a bond. These are the things I should be considering as I'm going into a bond. But credit risk is very key. There's a difference between lending to the government and lending to individuals, lending to blue chip individuals versus lending to mom and pop shops, right? So that default risk, how high is that? What's the likelihood that this person is going to default on me? It is extremely important to ask and consider. That is a major risk when it comes to investing in bonds. Now, what are the types of bonds available? Government bonds. So literally anybody can borrow, any corporate entity or any separate legal entity that is not a human being can issue a bond. There's a difference between lending to United States of America versus lending to the country Haiti versus lending to the European Union, right? Each of these entities can issue bonds. But what you would find is that the more comfortable you are with lending to that person, the lower the return you will get. That's literally how it works. like just take it like that. So you can invest in government bonds, corporate bonds, euro bonds. Now, what's the euro bond? The euro bond is a bond issued in a third party currency in another jurisdiction. What do I mean? Imagine Nigeria issuing a dollar bond in London. That is a euro bond. That is what it is, right? And then you can invest in their sukuk. Sukuk is Islamic financing. It's an Islamic bond, right? They're municipal bonds issued by a municipality, right? They are literally any separate legal entity that is not a human being can issue a bond. So we know when we talk about credit risk, you now have to say that whose risk is higher, is the return worth it, right? If there are two entities, one is the federal government and the other is a corporate entity in that same country, and the federal government's bond is at 20 and the corporate entity is at 20, I'd rather do the federal government, because at worst the government will print cash to pay me back. Right? So these are the things that you're thinking about when you are considering bonds. So how do you invest in bonds? Right? Unfortunately, on this video, I can't actually start listing out bonds because I don't know where you are. Where are you? What country? Like, drop in the comments. Where are you? So I can tell you what bonds to invest in your country. Right? But generally, these are things that you should look out for in your jurisdictions, wherever you have residency or citizenship, whatever documents qualify you to have access to the financial system, right? But where can you buy bonds? You can buy bonds through your asset manager, your stockbroker, your bank. Those are the three people generally that would help you in executing the trade. Your asset manager, your stockbroker, and your bank. So reach out to these three in your jurisdiction. And if you have any questions around it, please drop in the comment section. Now, the final and most important thing is, how do you make money from bonds? I've talked about your coupon. Your coupon will come into you. It's yours. Like, that's yours. That's the interest. That's the return on the investment. The other way that you can make money after your coupons is from capital gains. Now, this one is a little dicey, right? Because think of a bond as an asset. Think of that certificate as an asset, right? You have lent to the primary entity. Let's say it's the federal government. You have actually carried your money and given it to the federal government. Your money is gone. But you are with the certificate. You can decide that, oh, I really don't want to hold this bond anymore till 30 years comes, right? Let me find someone to sell it to. The moment you want to sell it to someone, it's no more primary market. You have entered secondary market. In that secondary market, you can actually sell higher than you bought, and that's where you can make money. It's called capital gains, and that's what traders do. Like, so you remember me saying that I started off as a trader. That's what we would do. We'll buy from the government and then see how we can sell it higher, or buy from someone else. Just trade, basically. So there's a secondary market for government securities, for corporate bonds generally. And so once you buy the initial one from the entity that issued, you can trade it, and in that way you can make capital gain or loss. Now, the final way that you can make money off that same bond investment is your investment return. And I talked about the video on compounding, right? Because you move out 100 million or whatever it is, and you are getting 1 million every 6 months. That 1 million, it's return. But if you carry that 1 million and invest somewhere else, well, is your 100 million still where it is? Yes, it is. You still have that, but you have now created new assets. Can you see how that works? So that is also another way, and a very, very important way to make money off bonds. Now, I trust this was useful. I hope if you have any questions, if you would like me to expatiate in any way, I recommend also that you watch the videos. The links will be in the description. And do not forget that you can't outsource your health and your finances. You have to engage. So in listening to this, you should be thinking about, how do I get bonds into my portfolio? Asking any questions you have around it, but most importantly, taking action, baby steps. Most asset managers, most stockbrokers, they offer lower entry points for these investments, so it doesn't have to be like, I must have so much money to get into them, right? So there are options. So I encourage you to actually start investing. Bonds are very basic, very easy to get started on, and I wish you all the best. Cheers.